you have an index at that particular stature, obviously the credibility automatically increases, right? So JP Morgan Global Bond Index, what they do is if they want to include any particular sector or any particular industry in general, it is decided that around 23 Indian government bonds will be included, and the exposure will be of around 330 billion USD, $330 billion.
Hello and welcome to Cut the Noise, your go-to podcast for breaking down the complex world of investments into easy-to-digest insights. Today, we are diving into a topic that's been making waves in the financial world: India's inclusion in JP Morgan Global Bond Index. What does this mean for all of us, from seasoned investors to those just getting started? To help us understand this better, we have Vedant with us, Manager of Corporate Bonds at GRIP. He is here to break down the complexities and share his insights. Thank you so much, Vedant, for joining us today.
Thanks for having me.
So, Vedant, my first question is, what is JP Morgan Bond Index and why it is so important in financial market?
So I'll just take a step back and I'll explain what an index essentially is, right? So when we say index, we mean that it's a basis for comparison, right? It's a benchmark, it's a tracker by which investors adjust their own portfolio and they make sure that they kind of match it to that particular benchmark or that tracker to some extent. Now talking about JP Morgan Global Bond Index. So JP Morgan Global Bond Index, what they do is if they want to include any particular sector or any particular industry in general, what they'll do is they'll increase their weightage. By increase their weightage, I mean that they will increase their allocation towards a particular bond. And if they want to remove a particular bond from their portfolio, what they'll do is they'll remove or they'll reduce their allocation or weightage for that particular industry or sector. It is important because it's a global benchmarking index. Institutional investors and a lot of foreign investors adjust their portfolio keeping in mind how the adjustment is happening in the global bond index of JP Morgan. Secondly, when you have an index at that particular stature, obviously the credibility automatically increases, right? So it is important because once a particular industry or any particular market exposure is increased in their portfolio, the credibility of that particular sector automatically increases because you get a sense of validation from an institution like JP Morgan, right?
So, Vedant, my second question is, what does inclusion of Indian bonds in JP Morgan Index signifies?
So the inclusion will happen in a phased manner. It won't happen all at one go because they would want to give some space and they would want to ensure that there is no major market impact. And obviously investors who are actually tracking their benchmarking their portfolio towards that JP Morgan bond index will be able to do it in a phased manner. So they will start by increasing their allocation by 1% on a monthly basis. They will increase it and they will go up to 10% by 31st March 2025. That is a cap for the inclusion. Now it is decided that around 23 Indian government bonds will be included and the exposure will be of around 330 billion USD, $330 billion. Now what does it mean to be included in that particular index? It means that you get, as I mentioned earlier as well, you get a sense of validation from an institution like JP Morgan, given the fact that it is globally recognized by a lot of investors. So yeah, you get a global level recognition. Secondly, in fact, it is believed that this inclusion for India, it will mean that there will be a capital infusion of around 25 to 30 billion dollars. Now that is again very good for the economy in general because you will have more forex reserves. You will also in the short term have a currency impact as well.
Is there any impact on Indian rupee as well?
Sure. So there will be impact in two ways. One is a short term impact and one is a long term impact. In the short term, there will be some sort of currency appreciation because there will be more demand of the Indian rupee in the global market, and accordingly the currency, the Indian rupee, will rise in the value versus the other foreign currencies. There will be capital inflows because once this transition has happened and all the 23 government bonds have been included in the JP Morgan index, uh, the investors would also like to adjust their portfolio accordingly so that they mimic the benchmark, and they would also want to start buying those particular bonds in their own portfolio. That will have a positive impact on the forex reserves because the foreign institutional investors will start buying more of those government bonds so that they can include it in their portfolio as well. So yeah, overall there will be more financial stability, and yeah, there will be rise in foreign exchange reserves as well for the country.
So, Vedant, many people have invested in corporate bonds. How will it impact the corporate bond market?
So as and when the government bond yields decline because of a higher demand from all the investors across the globe, uh, the corporate bond yield will also consequently start falling, uh, and that will actually lead to a lower borrowing cost for these issuers. So the second impact will be deepening of the Indian bond market. Uh, with the inclusion of the government bonds in the global portfolio, that will have a trickling effect, and consequently the investors will start having more awareness towards the corporate bond segment in the industry as well. And with that, once they have more awareness, they'll start investing more, and then consequently the demand for corporate bond segment will also increase.
So, Vedant, tell me, if you have to sum up this whole situation in few words, how will you sum up it? The inclusion of Indian bonds in JP Morgan index. What are the key takeaways for the investors and for all the viewers who are watching us right now?
Right. This inclusion couldn't have come at a better time because the government also wants to start increasing awareness and wants to increase the market participation of the retail investors in the bond market, and in fact that is why they've just slashed the minimum ticket size in the privately placed bonds from 1 lakh to 10,000. And with this inclusion, I think this will just create more awareness of the Indian bond market. It will increase the size of the bond market as and when more and more retail investors will start participating in the industry, and consequently that will have, like I mentioned earlier as well, that will also have a domino effect on the corporate bond segment as well, because with the government, once the investors exhaust their portfolio with the government bonds, they would like to explore more options, and they would like to seek higher return on their investment by shifting to corporate bonds, right? So overall the Indian bond market is on the verge of growth, and yeah, I think we can expect an increase in the volume in the next couple of months.
Yeah, that was very insightful, Vedant. Thank you so much for summarizing this whole topic in a very simple way. Thank you so much for joining us today.
Thank you for having me again.
And that's a wrap for today's episode of Cut the Noise. I hope you found our conversation with Vedant as enlightening as I did. It's always amazing to see how these big financial moves impact our everyday lives. A huge thanks to Vedant for sharing his valuable insights of wisdom with us. If you enjoyed this episode, don't forget to subscribe to Grip Invest YouTube channel. Hit that like button so that you never miss an update. We'll see you in the next video. Till then, get a grip on your money and go beyond. Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.